Well, the market finished slightly lower for the week, but the Russell 2000 continues to reach new all-time highs. Overall, the market's up for the month after that dramatic intraday reversal on May 2nd. Now investors are looking for the next catalyst. And I got to tell you something. I agree with comments President Trump made earlier about the market watching these trade negotiations very closely. Consider trade through April with the three nations that we're talking about, China, Mexico, and Canada. We've imports of $282 billion, exports $169 billion. But then again, what about traditional drivers of the economy and the stock market? Now, businesses we know are doing great. They're starting to step up these investments. The big question these days really revolves around the mindset of the American consumer. Consumers have the cash, wages are higher, disposable income after servicing debt remains high, and there's a lot less stress. But curiously, reality is emerging among consumers that this great recession hangover is here. We learned yesterday that we've got record low bankruptcies, record high household net worth, and yet record low credit inquiries. Then there's the competitive nature of retail in general, right? Particularly brick and mortar, which has been hit or miss. Earlier in the week, Macy's stock soared. Today, Nordstrom's was hammered. Overall, the S&P retail ETF it's been on fire. Next week, though, we're going to hear from a whole lot of retailers, including TJ Maxx, Kohl's, Target, Ralph Lauren, Tiffany, Best Buy, and The Gap. So let's find out where we are here. We want to bring in Steve Dudash, the president of IHC Wealth Management. Kevin Kelly's back with us as well. Steve, you know, listen, we broke that series of lower highs. We came off that 200-day moving average reversal. Earnings, for the most part, have been pretty good, but we're back in that sideways movement for the market. What do you make of it?
We're going to be sideways for a while, and a while longer, and a while longer after that. I mean, the market returns that we saw last year were because we were expecting global growth and because we were expecting that tax bill. There's not another tax bill coming this year. But let's not get hung up on and try to relate this back to 2007 either. You know, 2007, people were buying 5 houses on no credit, no income. That's not what's going on right now. We should be happy that our economy is doing well, that wages are starting to go up a little bit, that inflation is low, even though a month from now we're probably going to see that go up a little as well. But, I mean, earnings are good. The economy's good. Let's be happy with this. But you can't that does not necessarily mean that the market's going to turn around and go up 20% again this year. We're catching up to where the earnings are. We're in a good spot.
A revision to the mean kind of thing.
Exactly. We need that.
So here's the thing, though. It's interesting because consumers, right, they're not paying up for toilet paper and they're not paying extra for soup. Look at Campbell's. It got crushed on its earnings miss. Matter of fact, it actually missed 3 of the last quarters. It actually beat on this one, but the guidance was dismal. So we're not paying up, consumers, you know, for basic consumer staples. They are buying, you know, paying up for houses and things like that. If the consumer is 2/3 of the economy, where does that take us from here?
Yeah, the consumer is actually doing exceptionally well, including small businesses. But Campbell's Soup is just, it's a staple, right? You mentioned the XRT, which is retail. If you look at the XRP, which is the staples, that's been down. And because people are focused on experiences, they're going to experiential retail. They don't care about Campbell's Soup. They want nice, healthy, organic. If you look at what's happening, it's about bricks and clicks. It's not bricks and mortar.
What do you make then, Kevin, of this credit inquiries going down into the lowest amount in the 6-month period of inquiries ever? And since they started recording this, are people afraid to get extended? Because it feels like they're taking part of that tax cut now and paying off debt.
Yeah, and that's just being a very conscientious consumer, right? I mean, they don't need to tap credit to fuel their purchases because they're getting it back through rising wages, a healthier economy, return on their investment. So why would they tap their credit card, which it could cost them 25% APR, when they're seeing their paychecks go up as well as their investments? Right. So they don't need to tap their credit facilities.
So let's talk about the afterburners, right? Because I talked about this move off the 200-day moving average, Steve. Even if we go sideways for some time, at some point we've got to break. Will it be to the upside? And if it is, what's going to be the catalyst?
Well, it's not going to be buying retail stocks. Brick and mortar, that's dead. And the Campbell, like you guys were just talking about, people don't buy.
Well, what about consumer names like Amazon, Netflix?
Well, but that's different. That's not brick and mortar.
I know,
Amazon's
but it is a
great.
reflection of our consumers, though, right? It's part of consumer discretionary. What's going to drive our economy? What's going to drive the market?
It's almost not discretionary anymore. Amazon and Netflix are becoming just normal. Like, you have to have that. I mean, that's what's driving their innovations, making them get into every end of your pocket and every part of your wallet. That's not brick and mortar, though. That's not Macy's and whatever that are all earnings that are coming out right now. So if you're looking for growth, you need to look at areas that are going to have growth of earnings not just be in the general market as a whole, not just
Right.
get in retail end of the market as a whole.
Kevin, let me
look
ask-
international.
I just want to get Kevin before
Sorry.
we wrap it up, though. Where do you see this market going near term?
Yeah, in near term, I actually see the market going higher because I don't think there's going to be much more movement on the 10-year Treasury, which has been an overhang. We've seen the dollar get stronger. That's actually really good for the small cap. That's good for the American consumer. We want a stronger dollar. And so I think as those sort of factors that have weighed on the market, they'll start to subside, and we'll see earnings as well as the consumer take us further here. So in the near term, I see it going up.
Russell 2000 suggesting that the domestic economy is fine and dandy. Gentlemen, thank you both very much.